Rafael Markilos. I'm Professor of Finance at the University of East Anglia at Norwich Business School. And I'd like to welcome you to this seminar that we're running today from the Centre for Competition Policy, CCP. So I'll be the chair for today for the discussion, and I'll be asking some questions to our three great speakers. I'll let them introduce themselves over the next few minutes. And so we'll have around roughly 20 minutes each. Each one of the three speakers will have 20 minutes to tell us about their research and to respond to questions. All of you are very welcome to ask questions to the speakers. So please type these questions in. We will try and answer some of the questions today if there's time. If not, then we will collect these questions and respond asynchronously, to use a term that's very popular now with teaching. So via email, we'll respond to these questions. So let's get straight on to the questions themselves. But before that, I'll let each one of the speakers introduce themselves. So Paul, shall we start with you, please?
Yes, well, thank you very much, Rafael. I am essentially an economist. I was an academic for 10 years before I joined the Bank of England and ended up staying at the bank for 26 years, served on the Monetary Policy Committee and as Deputy Head of the Prudential Regulation Authority. But while I was there, I briefly took responsibility for the Bank of England's work on climate change. And when I left the bank in 2016, I took that interest with me and served on a number of policy groups, the high-level experts group on sustainable finance in Brussels, UK Green Finance Task Force, and I'm now on the Green Technical Advisory Group, which is advising the UK government on its green taxonomy. And I teach sustainable finance. And I recently produced a book, Making the Financial System Sustainable, which Rafael can, or Peter can send you the link to, which is a series of essays by my colleagues from Europe, principally around the green agenda, if you like, and what needs to be done.
Thank you very much, Paul. Afterwards, let's go to Dr. Patrycja Klusak. So, Patrycja, can you please introduce yourself?
Of course, thank you very much for inviting me. I like to be called Patty, but yes, thank you for correct pronunciation. And so I am a lecturer in banking finance here at the University of East Anglia, and I'm also affiliated researcher at Bennett Institute for Public Policy at the University of Cambridge. And my journey with climate only began maybe 2 years ago. I studied banking and, in fact, credit rating agencies and their regulations during my PhD at Bangor University. And after publishing some papers with that regard, I got together with some economists from Cambridge University, and we designed the first ever sovereign rating, which adjusts for climate change. And we have been on the news and featured in media outlets all over the world. And this has taken up a lot of my interest. And I'm actually producing more work on environment and merging this with ratings and how financial indicators can help financial markets to tackle climate change and its effects. So I'm very happy to be here today. And I'll be talking a little bit on the piece that we've done on climate. And currently I'm also working on other pieces with relation to biodiversity losses in countries around the world as well. And we are trying to design first ever rating, that sovereign level rating that could affect, take into account of the effect of lost species and plants and not only. And we are also working on some projects where countries approach us. For instance, Caribbeans recently have gotten in touch and they would like to see some assessments made for their countries and specifically to tackle their economic prospects, because they have slightly different scenarios than the remainder of our sample in the main analysis. So there's a lot happening at the moment and a lot of interest before COP26 as well. And so I hope that this research will be useful to you. Thank you very much.
Thanks very much, Patty. And last but not least, Dr. Ellen Quigley from Cambridge.
Hello, it's great to be with you all today. I'm the advisor to the Chief Financial Officer at the University of Cambridge on responsible investment, and I also wear an academic hat. So I'm a senior research associate at the Center for the Study of Existential Risk, and also teach sustainable finance. So I'm a kind of a critic of ESG as it's currently practiced. So often have debates on panels like these. And I wrote the university's report on divestment from fossil fuels, which somewhat unexpectedly resulted in the university divesting from fossil fuels, and also work on universal ownership and systemic risks.
Thanks very much, Ellen. So we're very lucky to have three speakers that are coming from a different angle here. So Paul, as he mentioned, so he's going to go first with the questions. A lot of the work he's done is from the regulation aspect, from the central banking aspect, and he's got a lot of experience in that area. A lot of this is reflected in the book that he recently edited. Patrycja Klusak comes from the perspective of banks and financial intermediation and credit rating agencies, so she can perhaps give us that perspective. And finally, Ellen, on more practical side, talks from the investment perspective and the institutional investors. So these are three different angles, and all of them are very, very interesting. This you might keep in mind when you asking questions. So I'll start with Paul, as I mentioned. So Paul, everybody's talking about sustainable finance. What is sustainable finance, and what is it intended to achieve?
Thank you very much. It's a great question, and it's one we normally spend a lot of time trying to avoid answering, because you can waste a lot of time debating it. But let me try and give you a very succinct answer. Finance, the financial sector in the economy, is extremely important. It provides a lot of services that support the real economy. On the one hand, it provides savings, it provides payments services, it provides investment opportunities, and on the other hand, it's providing credit services in the form of capital or equity to support growth in business and commerce. So the financial sector has this broad swathe of things, but in particular, it finances change in the economy. And that's what we're talking about. It has performed that role over many transformations in the past. Electricity, the internal combustion engine, the internet have all been supported by the financial sector. And in this context, what we're really looking at is the ability of the economy to finance the finance the economy in a sustainable way going forward. And in particular, in the context of climate change, that means supporting the transition initially to net zero, and in supporting the adaptation to global warming to the extent that we can't mitigate it. And what does that actually involve in practice? Because that's still pretty high level. I would break it down to two things. One is about taking a broader and longer term perspective of risk and return. There are longer term risks we need to take into consideration, which we wouldn't normally. And some of those longer term risks turn out to be crystallizing now. And climate and extreme weather events is one of those, where we're already seeing the impact of climate change, and it's going to get worse. So we need to reflect that in all our risk considerations. And also we need to make returns, but we want to make returns. If you're thinking of maintaining your franchise value for a firm, for example, or providing pensions or providing savings, you want those returns to be sustainable over a period of time, not to find out you're holding a set of high returning assets which suddenly lose their value overnight. So we need to take these broader thoughts about what risks are out there in the system into account. And then from a policy perspective, it's clear we need to grow new markets for products which are consistent with that transition. You can call them green markets if you like, but green bonds is one example of a new product, and there are many more out there. Now, one word of caution on all this is that the financial sector is full of problems and always has been. Problems of getting, for example, money to small, medium enterprises, problems of getting money to infrastructure, preferred habitats, short-termism, a whole raft of issues. Those issues don't go away just because we're talking about sustainable finance. And they won't be any easier to solve just because we're talking about sustainable finance. So there's a whole set of problems which perhaps become more acute, but they're just problems of finance. The sustainability aspects, in my mind, come from having this longer and perhaps broader consideration of risk and return.
Yeah, so I think it's a more broader sustainability agenda, and it's a nightmare, semantics in this area. I think an extra complication in finance is that in finance, things take a legal aspect, because we advise investors, and you need to classify almost investments in kind of ethical and non-ethical to because they have a practical implication. So, and in research now we talk about sin industries or non-sin industries. So it's responsible finance versus non-responsible finance. It's a very interesting issue. So thank you for that, Paul. You've done a lot of work with central banks, and you've got a lot of experience also with regulation. Everybody's talking about climate change or climate crisis. What is the role, you think, for regulation, governments, and central banks in resolving this crisis?
I think this is a controversial issue. It's one that people disagree about. And the problem comes from thinking about it in two different ways. On one perspective, climate change is an existential threat to humanity. It's a moral, social, ethical, political issue that everybody needs to play their part in trying to resolve. And that is true. But when you put it to people, often that stops them perversely from doing the right thing. People in finance will say, well, sure, but that's not my job. That's for the government to do. Or central banks, they shouldn't get involved, again, because it's for government to do. And the way we have to square this circle is to say, yes, it is a most social, moral, ethical issue, but let's put that on one side for a moment. Everybody has to take action on this because it is fundamental to what they are doing. If you're a regulator, you're there to protect the financial system, to protect investors, to protect retail participants in the financial sector. You're not there to protect the individual firm, but the system as a whole and these different groups, they are all at threat because of climate change risks. And we need to make sure as regulators that those climate change risks are properly managed, that they're properly reported on, that people aren't cheated into short-term returns which disappear because of climate-related risks. So this is fundamental to the objectives of regulators as regulators. You don't need necessarily to change mandates or objectives for regulators for them to realize that this is important for them to take action. Very similar for central banks. Climate change affects everything they do. It affects monetary policy, affects financial stability, it affects prudential regulation where the central bank is the prudential regulator, even affects things like printing banknotes and the bank's own operations, affects their collateral frameworks and all these things. So they have to take it into account because that is their duty in terms of their existing mandates and objectives. And there's a lot of nonsense talk about, oh, why are people stretching their remits or their objectives to take this into account? Well, they aren't. They're approaching it from their own lens and their own existing mandates. And I think it's important to remember that. But that what they can't do is nothing because their existing mandates and objectives require them to take action.
But do you think that there's market failure? I mean, one of the ways of interpreting the need for intervention is that there is market failure. Is climate crisis or a result of market failure?
Yeah, I think because of the great financial crisis now, there's a much more better appreciation that there are market failures rampant all the time, including in the financial sector. The big one here, of course, is that there are externalities from sustainability. I'm going to focus mostly on climate, but actually the same arguments apply to biodiversity, to social issues, to gender equality, a whole range of other things. Carbon emissions are not priced at the point that they are emitted. It's a sort of free good. People can wantonly pollute the atmosphere. And that means you get too much of it in terms of society. Now, what we should do is price that externality so that it's reflected. But actually, I would go further and say that although we need to do that even now, it's too late to rely on that being the solution. We need to actually stop these carbon emissions. We can't, there was a time when you could have said, well, if people are paying for it, you could use that money to then mitigate and offset the impact. I don't think we're in that world now. We need to reprice carbon. For example, at the moment, there is no tax on aviation fuel. And so we are basically subsidizing the air industry relative to other forms of transport. And the way to get the air industry to invest in alternative fuels would be to jack up the price of aviation fuel to reflect the carbon emissions, and that would help move things along its way. And you could use that money to invest back in the technology, and it would reduce the amount of air travel. And so there's a lot to be gained, but actually we need to stop that subsidy, and we may need to think about controls on carbon emissions simply because we're so late in taking action to address it. So there's big market failure, But whether or not we can use traditional market failure mechanisms alone to deal with it, I am rather doubtful now. We needed this mixture of those mechanisms and direct controls.
And obviously, there's a lot of publicity in this issue and what governments are doing and regulators and politicians. I mean, on the basis of your experience, and you've seen how regulators have moved on different topics over the years. Do you think that the regulators and central banks and governments are moving at a reasonable pace? Do you think that it's nothing close to the speed that is required? What's your feeling? What did you think?
It feels glacial at times. The central banks and regulators are getting involved, but the mere fact that some are much further along the line than the others tells you that they're not all moving as fast as we need to. And I am slightly concerned that where you get a country with a central bank doing so much, it can give the government a bit of an easy ride. The central banks, the regulators can't in the end drive finance and to drive the transition because it's pushing on a string. You need the real economy to develop, and you need people wanting to borrow capital and equity and to want those financial services, because you can't make somebody borrow if they don't want to. We need to be incentivizing the real economy, directing the real economy through government, not relying on the financial system to do it on its own. The financial system, with the help of the regulators, will come in, but they need a real economy to be supporting, otherwise it's not going to happen.
And in terms of the type of interventions, I mean, do you think that it is an issue of fine-tuning the whole system, or does it really need dramatic changes or solutions or a completely new thinking of approaching the issue? Will old regulatory solutions work in this case? You talked about that perhaps not being the case.
Yeah, I think the problem is we have lots of initiatives and lots of policies. What we don't have is an overall strategy that's clear and coherent to everybody, that everybody can understand. And sometimes that means we lack ambition in policy. Sometimes it means we've got policies which are working opposite to each other. We're doing things on one hand which end up emitting more climate things. Sometimes you can get very simple policies which work wonderfully well, like charging people for carrier bags in supermarkets. What a fantastic initiative that was relatively painless. And yet other times we just really struggle to come up with ideas about shifting the dial. And I think we need to be much more ambitious with where we're going. The way it is at the moment is historically Europe and the US have emitted most of the carbon. They are still big carbon emitters, even if at the moment they are not the largest contributors in the world. It's now coming more from Asia. We still import a huge amount of products from Asia, and so we're essentially importing carbon emissions made elsewhere. So Western governments still have a huge role to play in driving this. And I'm afraid even leaving it to people's own devices is not sufficient. What we need is system solutions here, and only really governments or coalitions of the willing can come together to provide those systemic solutions.
Another question about we've got 45 colleagues here in the room, and all of us are working in different areas, in regulation, in law, in economics, in banking, and so on. Some of them not in finance, and a lot of them not working in sustainability per se. Sometimes I feel that working in sustainability is a bit like recycling. It's not an option. Yeah, you've got to do it, and it's our responsibility. So why should I care as an academic about all this stuff? Is it of interest, general interest, or should I really be doing something in my teaching and my research?
Yeah, well, I think, I mean, there's the naked self-interest point, which is this is what students want to study and hear about, and it's where research money is going. So from that point of view, people should be interested. But I think the biggest hurdle I face when I'm talking to people in financial markets is getting them over that initial hurdle of realizing that this is something which they should be taking into account in terms of their day job. They shouldn't just be taking it into account because it's the right thing to do. They should be taking it in because it fundamentally affects everything they're doing. And I don't think there are any academic topics where climate change is not going to play a very important role in determining what the interesting research issues are and what the way the subject should be taught in future. And there will be an aspect of climate change or other sustainability issues which come into play. And I think the academics who realize that and work into it, we'll be producing the better research and the better courses for people to study. And the people who think, oh no, this isn't my subject, it's somebody else's subject, they're just going to miss out on that opportunity. I think people just need to think that, going back to that broader, longer term context, what am I going to be teaching in 20, 30 years time? How much is this sustainability agenda going to change it? Because it will. And if you want a career, particularly if you're sort of 20 something now in academia, you've got to be thinking about how this is going to be impacting on your topics, what you're going to be doing with your time for the next 30 or 40 years.
Thanks, Paul. And one last question from me, which is a bit of a trap question. So it is recorded, Paul, so you've got to be careful. So question about predictions. So I'm very, very interested in predictions, but I'm very careful. I always give short-term predictions, but I'm going to ask you to make a prediction. It's about next generations. I mean, all this experience of expertise you've got, what do you think is going to happen? So in 50 years, from the perspective of regulators and government, how will things change? Are you optimistic, pessimistic? What do you think?
Well, some people will know that I used to be a macroeconomic forecaster, and I know you can't forecast the economy 2 years ahead, right? So not with any degree of precision. But it's like all these things. There's some things you know, and some things you're very uncertain about. What do we know? We know the world is going to keep on warming for quite some time, regardless of what we get to. We know that if we don't get down to net zero and indeed start taking carbon out of the atmosphere, the planet may well become unlivable at some point. So we know we're going to get more extreme weather events. We know all these risks are going to start to crystallize and people will panic. And really, there's two scenarios I'll point out. There's the good scenario in which everybody realizes that action needs to be taken. We start that early. We probably just about don't go over 2 degrees warming. I think 1.5, frankly, is long gone in terms of what's inevitable. We managed to keep it under 2 degrees. And then we realize that we have to keep taking carbon out of the atmosphere. And this is going to be an agenda which lasts for 100 years or more, not just the next 30. That's the good scenario. The bad scenario is we don't. We don't do enough. Governments, particularly in Western democratic countries with short-term horizons, talk a good talk. They don't actually put things in place. We can't convince the rest of Asia to do what we want. And the planet keeps on warming. And that way leads to disaster. It leads to certainly millions of deaths, if not worse, as the sea level continues to rise and many of the big Asian cities end up underwater, which isn't hypothetical, by the way. Jakarta, capital of Indonesia, they have already announced is going to have to move because it's sinking. So a lot of this will happen. And then eventually people realize they have to do something and you get a mad scramble at the end, which comes too late and is much, much more expensive. So I think that's sort of the range of scenarios. I'm hoping we get to the good one. But you can see quite a lot of things coming. If you're in business and finance, you can see quite a lot of the regulatory agenda that's coming down to you in terms of disclosure, in terms of labels and standards, in terms of risk management and regulatory interventions. That agenda is quite well mapped out now. You can see the change coming in demand for goods and services. And you can play into that if you're in business. So unlike a lot of previous transitions, quite a lot of this one is already visible. And it just requires people to grab it and run with it.
I didn't manage to trick you there, Paul, but you gave a range, which is all economists do the same thing. I'll just give you a range. And so how much is this worth? I'll give you a range. Fair enough. I mean, I'm joking. There's one question in the audience asking about green bonds and investments and what will happen if the yields from these are lower. I assume that this is compared to traditional investments. So what will they be popular? So if green investments or bonds have a yield that's lower compared to traditional investments, are they going to be consumed? Will they get an ethical utility out of these?
Okay, the guess is interesting because it's precisely wrong. When the green bond market started, most of the bonds being issued would be flat or at slightly higher yields to existing bonds, most of them. There'll be a small premium. And there always is a premium in the new issue market, but I think people thought this was sort of flat to a premium at best. What we're now seeing is green bonds being issued at lower yields, which is much better from the issuer's point of view. of course. It's a greenium is the word that's used to it. But this is because of the incredible demand there is to hold green investments. It's got nothing to do with the costs. The order book for the UK's green gilt recently was 100 billion, and they ended up selling 10 billion. Now, it's not unusual, I have to say, in capital markets for these order books to be inflated. But this probability of pricing through the normal debt curve is increasingly common. And it just shows at the moment what we're facing is there's plenty of supply finance out there for green investments. What we're short of is the green investments to finance. And we need to be doing more in the real economy or with market standards or whatever to generate opportunities for the financial sector to step into. And basically, as the yields come below normal, what should happen is that issuers should start to say, well, this is no longer going to cost me money, if it ever did. This is now going to be beneficial. So it will encourage many more issuers. And there are all sorts of side benefits as well. I think when people have issued green bonds, they found that equity price goes up because you get a sort of a green halo effect in other markets. You open yourself up to a wider group of investors, which lowers your cost of capital in the long run. So even when there was a small premium, issuers thought this was very financially worthwhile taking the broader view. But with a greenium, it becomes even more important to try to get into these markets.
Thanks very much, Mark Reeder, for the question. So anyone else having questions, please type them in. And as we said, we'll try and answer them here like this one, or we'll answer after the event. Paul, thank you very, very much for the insights and for the questions. If we want to hear more about this, the book that you've edited is really great. So people are encouraged to go and have a look at it. So Patty, I'd like to ask you some questions now from, again, the perspective, as we mentioned, of banking, credit rating agencies, and in general, financial intermediaries in the private sector rather than central banks. So how can banks and credit rating agencies help in resolving the climate crisis? Credit rating agencies got very bad press in the crisis of 2008. There was one body of research and the press that thought that they were to blame. Are they doing something wrong now?
Okay, thank you very much for this question, Raphael. Yes, if you think of credit rating agencies, they are quite controversial, and they have been blamed for many things. In the financial crisis, they have been blamed for being lenient when rating corporate asset, corporate issuers. When the sovereign debt crisis happened here in Europe, they were blamed for actually downgrading too far and too fast, and that effect then spilled over, from many nations. And I think one of the biggest issues that remains with credit rating agencies, so CRAs, if I use abbreviation, if that's okay, is that the methodologies currently don't account for climate at all. And that's something that will need to change in the near future, because in a way that what we're using as a credit assessment, this indicator is not up to date, and it's lacking something that's actually happening. And we know that from climate science that actual changes in the temperature and precipitation do have effects on productivity of nations, and they have effects on GDP or GDP growths. And if they're not accounted for in measures of assessment such as sovereign ratings, that's a very serious issue. Why sovereign ratings are so important is also, well, you're going to the markets and you're trying to evaluate the cost of debt of your investment. If you are investing your money into sovereign credit, sovereign nations' debts or bonds and government bonds, the way that rating agencies currently look at them and assess, that doesn't just actually affect the country's debt. It also has an effect on debt and cost of borrowing for other issuers in the country. So if you think of Italy's rating being downgraded or UK's rating downgraded, that's not just affecting those countries. It will affect the banks in that spectrum and also corporations. So there's what we call a ceiling effect that ratings impose, sovereign ratings impose. And so this is a rating asset that is important. We also hold this asset in our, when we investing in our pensions and so forth. So that's something that Ellen is probably going to talk a little bit more about, but we shouldn't be underestimating it. So another thing, an aspect, and I think that's how markets can help and sort of come in handy, including banks, financial institutions, is helping to not only estimate the effect of the physical damages and physical risks, which then translates into the actual losses to productivity and nations' GDP. So far we see, yes, how temperature affects, output and so on. But what about things that are transition risks? What about refugee crisis, social crisis? What about things that are currently happening, let's say, in Greece or in Turkey? So what about these social crises that are gonna become more and more severe as a result of climate change? So we don't have indicators currently that could help us to estimate and calculate the cost, and that we could then price that cost into managing risks and trying to avoid them. So I think that I would say is currently missing from the rating is that the credit rating agencies at the moment are not focusing on long term. Okay, so they are looking at what they call 5 to year horizons, but in reality, it's not that long. Most of the rating assessments are made up to 5 years. And when you think about what the investors want and what governments recently started doing is they're issuing ever long-lived bonds. So if you think of sovereigns such as, I don't know, Belgium or Austria or Argentina, they've issued 100-year-old bonds. And if you think of France, they're looking into tapping into 5-year tenures there. So life insurance companies and also pension funds, they are eager to actually hold long-dated papers to match their liabilities into the future. And extending this yield curve is not only something that's happening in emerging markets, it's also a feature of advanced economies. So when the super long bonds mature, we have then two trends which are present. It's the demographic changes, it's the fact that we live longer, and it's also the climate. And although obviously investors should concern with both, it is already quite established in the literature how to calculate the effect of aging population, and there are models that help us to estimate that effect. And it's much more understood and quantifiable. And you think about the science behind the actual mechanism of climate and how that is affecting us is either very complex and or it's poorly studied or understood. And how we can actually then plug that into our indicators still remains a challenge. So I think for the action point for sovereign ratings or for any ratings, and maybe regulators at the same time when they're actually thinking of this, it should be something in designing actual long-term risk assessments, which will help investors to match the long-term reality, what's actually happening with what they're facing. And in the short period that we're currently facing, and also what Paul said, is only a couple of years ahead that the assessments are being made currently. That's something that is not good enough, unfortunately. So I would probably urge, that there has to be some sort of transparency and increase in that, and the contribution from the financial markets that will make the allocation of funds, investable funds, more sort of realistic, rather than just focusing on very short windows. So that, I think that would be my answer to that. Sorry, mute.
The research, your research is the timing is very good. So it was received very well by the press, the paper that you recently wrote, and there was a lot of interest. So obviously it met a need. But one of the points that you raised, and I think it's a very interesting one, very often when we talk about the effect of climate change, we say that there's a lot of unfairness. So as Paul mentioned before, a lot of this pollution and the causes of climate change have been created by developed nations, but the actual effects are seen on developing nations that didn't create any of this pollution. And this is a lot of unfairness. This is why some developing countries are saying, well, we don't have to pay for this. You guys have to pay for it because it's your problem. You've created it. But unfortunately, they're feeling the pain of climate change more. But it seems that your research is pointing out something different that people were not expecting. So what is this? So it seems that in the case of sovereign debt, it's different.
Yes, we are in a way we are challenging the sort of wisdom, that conventional wisdom that will suggest that it's only the poor nations that are being hit by climate change, and it's not affecting the developed world. And so I don't want to be obviously controversial here. One thing that we've done in this study is, I'm going to explain why that might be that we find slightly different results, is because we are looking specifically at cost of debts of sovereign nations. Okay, so we're not looking at probability of defaulting here, although I will get to that in the future as well, and at the end of my sort of answer. So basically what we are using is a sort of a soft linking climate and economy model designed by one of our co-authors at Cambridge University, Khan et al. And in that model, the authors are able to look at precipitation changes and temperature changes over 100, I think 15 countries. And what they do, they study their effect on the GDP and GDP changes of nations. And what we do in our research, we are looking at the methodology that's widely applied by rating agencies. We don't know the model exactly, but we are hacking the model using the insight from our co-authors who used to work for S&P. And what we do, we are sort of simulating, we are not forecasting, but we are simulating using different warming scenarios, what would be effect of climate under, let's say, 2-degree warming, 5-degree warming, and warming the variability of temperature on sovereign ratings in 108 nations. And what we find in our results is that it is the developed world that is most hit by the downgrades. Okay, so the sort of, if you're having a scale, if you're losing from AAA to, let's say, A or A+, we are talking about these downgrades on the sort of ladder, rating ladder. And so what we find is that these guys are getting punished most. Well, there could be a couple of explanations to that, and in a way of explaining that this challenge this wisdom. One of that is that actually in the model of our co-author, it is the developed world and developing world will be affected by climate change. There is no question about that. And the reason is that they actually stipulate and they're able to see that it's not just the trend in temperatures that matters, but it's the variability and changes in the temperature. So if you're thinking of the infrastructure that is built in countries where they are used to having a hot weather and the office buildings and places are sort of using air conditioning, and suddenly you have a very cold temperature. Let's say, oh, we take an example of Texas last year, you have freezing pipes and not enough infrastructure built to cope with sort of -5 degrees Celsius. Although it's not uncommon to have relatively cold temperatures, but yes, they are hit and there are people and there are fatalities as a result of that. So what we mean here is in our model, we are just not saying that the temperature is going to rise, but it's also that it's going to become more unpredictable and it's going to jump from, you know, hot to cold and so forth. So based on that, and economy models actually suspect and predict that this is going to be affecting productivity. So if you think of a hot sort of type of infrastructure built for hot weather, and then you're suddenly having freezing temperatures, your employees are not going to be productive enough. They will have to, you know, wear warmer clothes, and there will be all of that effect. And if it's the other way around, they will be too hot and not productive. They will be falling asleep in the offices and so forth. So this is what the economic models and climate models are trying to say. So if we then think of actually how that's going to affect the sovereign credit worthiness, that's going to work for as bad for the developed nations as for the developing nations too. Another reason to remember is if you think of countries which are at the bottom of the ladder, so they have quite poor credit worthiness as it stands, because maybe they have a high level of corruption, they have political uncertainties, they're in a state of war. These countries will have relatively low rating to begin with, and there isn't really that much to lose for them. So, and an extra effect of climate change, you know, on top of, let's say, Argentina's problems and several bankruptcies, wouldn't really make that rating much lower. Okay, so there is not too much to lose from that perspective, because we are looking at the credit worthiness levels. And another thing that we probably should mention is that when we're looking at these effects in our paper, we are mainly looking at physical and we are not able to find indicators yet. We are not implementing them in that piece, although we are working on it now, of transition risks and other risks. So that's something to consider. So we have been challenged by some speculators and asked, what about this non-linearity between actually if Belize is being downgraded and US is being downgraded? That's not the same impact on of probability of default. So what we started doing now is actually thinking, yes, that's actually true. So rather than using downgrades in our specification and our modeling technique, we are actually looking at probability of downgrades just to deal with that, and the results still show this sort of strong impact for the developed nations. So I guess that would be the way of explaining it. So yeah, thank you.
Thanks very much, Patty. One final quick question, which is a bit selfish. Let's forget the webinar for now. I mean, I'm getting on, and I'm thinking about my pension, and I've got some savings at the bank. All the research that you're doing, is that relevant? I mean, should I worry about my pension, and should I care about where my money sits in terms of savings in the bank? What does your research tell us about that at the individual level? Will this happen over the next 15, 20 years? That's what I'm planning to kind of retire.
So
or is it in the far future? I'm okay.
We do make relevant sort of simulations. I'm a little bit going to be diplomatic like Paul here, and I'm going to rely on simulations rather than actual. So yes, it all depends what's going to happen in terms of us following on our agreements and what we find in our piece. And because we're looking at a scenario where we follow Paris Agreement, and which is a 2° Celsius warming scenario, and we go into the sort of much worse case, although that's the 5° world is not so unrealistic given our emissions in the past 15 years or so 5° warming. And we're also looking at the 5° warming. So if we don't take necessary actions with the variability, which is also on top of that, with changes in peaks and troughs of temperature arise. And what we are able to say in the next 80 years, we actually give some sort of simulations for 2030, 50, 70, and 2100. And what we first do, just to explain, we first looking at the sort of cost and effect on sovereigns, and then we translate that into the banks, how much the interest will be affected for banks as well as a result of that. So if we stick to Paris Climate Agreement, we don't find significant differences to the ratings that there are today that are being observed, which is good, and we can obviously be hopeful that is the case. And then the cost of borrowing for banks as a result of that will not be majorly affected. And obviously that what goes with it is all your investment with relation to the pension that you were asking. But if we are in fact going into the 5° warming, which some people think it's not going to happen. Well, I wouldn't be so so much against actually that. As I said, we are on the track on that for the past 15 years. Then we find that there is quite significant downgrades that we observe amongst nations. And so what we call 8.5 scenario, if you read our paper, we find that 63 nations will experience climate-induced downgrades by 2030, which is only, 9 years from now. And the average of that will be an effect of 1 notch. So what we can then say, if you're looking into much longer, sort of ultra long, up to 80 years in the future, then we find that this will be increased to 2.5 notches by 2100. And that's not just notches. If you then translate these costs into an additional cost of borrowing for countries which are most hit, for instance, if you think of Chile, China, Malaysia, even Canada, Peru, they will have at least 5 notches downgrades by 2100. So that's going to increase the cost of borrowing. So if I give you an estimate of how much we think additional cost of borrowing for sovereigns only will be, is between 137 billion to 205 billion. So there are lower and higher sort of estimates. Just additional costs. It's not actual cost of borrowing, but it's just the interest that is going to be on top of that due to climate. That then translates into much more cost of borrowing for corporations and for banks, and we estimate these numbers. But what the main message is from this is that obviously, yes, you should think about it and you should worry, and we should all worry, because if things go wrong, then it will be more costly to borrow for all of us, and obviously our investments will be affected as a result. But if we make efforts now, we will be able to sort of mitigate that risk and shield against that. So yeah,
I was hoping to be able to sue you on the basis of your answer, but I don't think you don't give me too much ground there. So thank you very much, Patrycja. I would encourage all panelists to respond to the questions as that people have posted on the chat. Paul has done that already. Ellen, let's go to you. So tell us about institutional investors, last but not least. So we heard it from regulators, the perspective of regulators, and from banks and credit ratings. How can institutional investors help in resolving the climate crisis? And beyond that, even individual investors, what do you think? Can they help, and in what way?
Yes, I mean, just to reinforce what Patty and Paul have said, I mean, those are critical entities as well. We need a lot of government regulation. We need regulators and ratings agencies to respond clearly. But I think that institutional investors have a unique role to play because they are among the only entities who can actually address the externalities that Paul was talking about earlier. This allows me actually a chance to critique ESG, which is my favorite thing to do. ESG tends to give people the illusion that they're addressing these externalities while doing nothing of the sort. And what institutional investors could do is adopt more of a systems approach and look at things from a kind of inside out perspective. So I talk a lot about universal ownership, which is basically the idea that if you're, say, a large pension fund, you own a more or less representative slice of the entire economy, and there are no such things as externalities for you at that point, because the costs associated with one company emitting will get picked up in the rest of your portfolio, and Patty's study is only one of the ways in which that could happen. What that means is that there's no advantage really to trying to escape these externalities by stock picking in public equity, where there's really no impact on the companies involved. And I've looked at that, looking at various studies that examine that question. Instead, you have to look at what power do these institutions have to level the playing field for all of the competitors operating in different jurisdictions with perhaps different regulations. And that could involve setting guardrails, so to speak, below which companies should not fall. So on climate change, it could be no new fossil fuel infrastructure, no new exploration for fossil fuel reserves, that sort of thing. That's what the science tells us needs to be done. And right now, any company that adheres to that relative to their competitors may be actually at a disadvantage. So universal owners basically kind of turn things on their head. They're not as interested in trying to narrowly protect their own portfolio because there's really no way of doing that, especially over the long term. Instead, they're more focused on how do I actually shift company behavior, and that has to do with I would posit two things. One is voting against the re-election of directors on the basis of sensible guardrails. That my research suggests that that's a lot stronger as a mechanism than advisory shareholder resolutions, for example. And to the point someone made in the chat, which is a very on point one, most shareholder resolutions ask for disclosure only, and we've spent 20 years messing around with disclosure requests. Disclosure is important, but it can be requested as a condition of an actual outcome that you ask for. So if you say, you have to reduce emissions by blank amount, you can get disclosure because they have to prove that they've done that. But instead, it's a means to a proper end, not the end itself. And if you look at studies associating disclosure with actual outcomes, there isn't a clear link. A lot of studies disagree on whether there's really much of a difference at all among companies who disclose better. So anyway, so that's my, I do think that institutional investors have a unique role to play because they can kind of manage externalities across borders in a way that even governments can't do. And it could be supportive of the efforts of these other institutions we've talked about.
What are your predictions about changes going forward with institutional investors? Do you think they'll change their behavior dramatically? I mean, myself as an observer of markets, I've been amazed about the whole responsible investment movement amongst individual investors and as a response amongst institutional investors over the past 10 years. If somebody told me 15 years ago that this change would occur, I would say nonsense. I mean, this is not possible. This is a niche. People don't care. I was quite cynical at the time, in the beginning of my career, about how much change could occur. But talking to younger people now, and even people of my age, yeah, this is what people want. Even if it affects their pensions directly and indirectly, it is a real need. This is not a niche.
Yeah, I mean, I think you're right that now it is kind of the de facto preference, especially among younger generations. But the problem is that most responsible investment in the past 20 years has been useless. The emissions of the companies involved have gone up. Overall emissions have gone up. And it's because of this lack of an impact lens. It's all about trying to reduce risk to your portfolio, which is a futile endeavor. So we've been rearranging deck chairs on the Titanic for a couple of decades now, and we really do need to kind of switch things around and look at proper impact.
Is this something I can do as an individual investor? So all of us are holding, I don't know, pension positions, and we influence others, or we talk to students and so on. Is this solely in the hands of regulators and institutional investors that hold billions? Or is it, again, a bit like recycling, that we all can do our own bit?
So recycling isn't that impactful either, I have to say. Sorry. But I think that there are, if we look at the most high impact things we can do, probably weirdly, one of the most high impact things you could do is write to your pension fund, because they only hear from like 5 people a year on any issue at all. And you could usefully do a couple of things. So they get a lot of pressure on ESG, but actually directing attention to director votes, again, that is a much more powerful mechanism in terms of company behavior change, but also directing attention to debt. So if you look at a lot of ESG commitments that institutions make, it ignores the private markets and credit parts of the portfolio, which is where there's actual what's called additionality, as in it can actually affect a company's cost of capital if people pull out of certain activities or add new capital to fledgling industries that we want to see grow. And that's exactly the opposite of the way we should be thinking about things. I would actually like to see much less stock picking and much more denial of debt to companies that really need to change. So if you were to write to your pension fund and say those two things, director votes and pay attention to your bond portfolio and private equity, that, if they were to listen to, doubling the responses they get in a year would be viewed as a massive increase in interest, and they do tend to take these things seriously. So any chance that they change even one tiny element of how they invest in the whole pot because of increased pressure from beneficiaries, that's probably among the ways that you would have the most impact as an individual.
What about our employers? A lot of us work for universities, and again, because of students, they will advertise activities and policies around sustainability. Is there something we can do to influence our employers in this direction, beyond teaching, let's say, at the everyday level?
Yes, I mean, so I wrote the university's report on divestment, and I actually changed my mind in the process of doing that, because I used to kind of put divestment in the same category as ESG, symbolic only. But actually turns out that divestment has probably affected public discourse. And the theory of change is one that I didn't properly understand initially, which is that as a society, we don't legislate things that we don't view as morally problematic or, or an issue in some way. And what we really need in this area, I think we would all agree, is more regulation. We need government intervention in this way. But the way to get that for fossil fuels is through social opprobrium, sadly, because that's the way you can get that that sector to be viewed as legislatable by the people who have power to do so. Universities have a lot of legitimacy, and if they are able to stigmatize these companies, it makes it more likely that they will be legislated by politicians. So that's actually a very important move, and I would extend that to research funding and benefactions, and so on and so forth. The reason, by the way, that it's important to focus on fossil fuels is that, and I used to be in a completely different camp on this. I used to advocate for something called positive investment. But actually what we've seen is that although the green investment has been growing, so has fossil fuel funding. And that's the issue. There's been an addition as opposed to a transition. And the vast majority of global emissions come from fossil fuels. So actually we do need to focus on decreasing fossil fuel usage. And that would have the happy benefit of pretty much automatically helping to build out renewables, but we can't just put the focus on building out renewables without addressing the fossil fuel question as well.
We talked before with Patty about the issue of fairness and how the whole climate change issue affects differently different countries around the world. And I know that you've done work on inequality. This is something that we often don't talk about in finance, but much more in economics. So do you think that this is relevant? So what institutional investors do, can they affect or should they affect inequality in relation to climate change?
Yes, absolutely is my short answer. So universal owners, because most of their returns come from overall market returns, again, should care about inequality, because inequality has a macroeconomic dampening effect. If you have a hollowed out middle class and a lot of low wage earners, that's bad for the economy overall. The problem is that investors can't actually shift wealth inequality, which is where the vast majority of, I mean, that's much greater than income inequality is, and that really has to come down to government action. But they can influence income inequality. So one of the guardrails that we're proposing actually is a living wage across all jurisdictions, through subsidiaries and subcontractors and so on and so forth. We think that if all low wage earners employed by large multinationals were to be paid a living wage, that would have to have an overall benefit to the economy.
Often, so thanks very much for this answer. Often we rationalize and we think things in finance and in investment in terms of risk and return. And as you mentioned, we might say that this is it makes good business sense to think about inequality and other issues. But more widely about inequality and the whole sustainability agenda, should we always frame it, you think, in terms of financial terms? I mean, that it's good business sense in the long term. Is there room for ethics? I mean, should we care only on the basis of ethics? Is this a thing? Can we tell investors that ethics are important, and you're going to lose money, and there's no free lunch. You will lose money because that's the right thing to do. Is this possible, you think?
So I think that's a great question, and allows us to dig into a couple of key things. I mean, one thing to emphasize though is there are some issues that are systemic, where you actually lose less money if you're a universal owner by addressing those problems in the real world early on. Things like climate change and inequality and antimicrobial resistance, things like that, where there's a clear economic case. And that could involve, by the way, losses to individual companies in your portfolio, because otherwise, if they profit maximize, they would impose more externalities on the rest of your portfolio. So you have to be able to be willing to take losses on individual companies to benefit the whole system if you're a universal owner. But that doesn't really address your point about ethics either. And I actually think that that's an important element in all of this, and something that I discounted before doing the research for the divestment report. If you look at the development of legal regimes in our various countries, it has a lot to do with morality. Moral arguments are kind of the underpinnings of norms and legal regimes have this kind of amazing feedback loop. So I think we have to bring that into the conversation as well. And interestingly, even though universal ownership rests on this idea that actually you do save money in the long term by addressing these risks, if you look at studies of pension beneficiaries, for example, they would be willing to take a hit even if that had to happen in order to achieve societal goals. People are not the profit maximizing entities that we are sometimes taught to believe. So I think that's really interesting and an important part of the discussion.
I started off as an economist, and I think I tried to spend my career trying to forget about my political economy, let's say, foundations, and finance often does the same. but I think you can't avoid it. So you'll always go back to these moral issues and the political economy, I suppose, and the foundations of it. That's the choice at the end. I tried to track the other two speakers, but they tried to avoid it. So with the predictions, I'm still trying to build up a case for a lawsuit in a few years. So Ellen, tell me, what do you think is going to happen over the next 30 years, 50 years in terms of investors? What is going to change? I mean, if we fast forward, is it going to be a completely different world? Or is it going to be a climate mess, and we're just going to be investors are going to be doing business as usual?
I'll take the bait. So first, I do want to say that humans are terrible at forecasting, and there are studies to show that. Nevertheless, I'm aware that sometimes forecasts or predictions can be self-fulfilling, and I think that leaves us with the responsibility to talk about the forecasts that we would prefer to see come to fruition. One of the things for institutional investors is that I predict that the definition of fiduciary duty will change, so that not only will it become commonly accepted that it is permitted to manage a portfolio on the basis of managing systemic risks and universal ownership, but I think it will become required, because that is the only way you can actually protect your portfolio in the long term. So I actually feel fairly confident about that one, while feeling not very confident about almost any other prediction I could make that far away.
Thanks very much, Ellen. So we're just over the hour, so I think I'll start speaking now. It's been a real pleasure talking to our three speakers, or three guests today. It would be great if we repeated this again in person when things are a bit settled down, COVID, from the perspective of COVID. But it's really been great. I mean, I've learned a lot. There's questions that are going on in the chat. So as I said, we'll try and respond to these today. There seem to be no open questions, so people have been active in answering them, so that's great. So that's all. I know you've got other things planned, so I think we'll call it a day. Thank you very much for CCP for organizing the webinar today. It's been great. I hope you've found it useful too. Thanks for the speakers for contributing. I'll close the discussion here. You're all free to go. Thanks very much.
Thank you, Raphael.
Thank you very much.
Thanks.
Have a good day. Bye.
Thanks all.